Everyone, welcome to Blue Dragon Actuarial. Today is 27th of June 2022. So today we are going to go through a circular that is related to derivative. Now, since we are kind of doing the ALSM and the capital management portion, so this circular was very important. So this circular also you can see this is a big circular. There are a lot of points written here. However, it is not as complex as GN22, which is the cost of guarantee. If you have not seen that, please go and watch the video. That is very important to understand how cost of guarantee works, and that is kind of produced by the Institute of Actuaries of India. So you can understand that like you if you are working on some financial guarantee, then going through that circular would be no, not circular, going to that guidance note would be very important. Now this is a circular, so that's why you'll see that for the derivatives it is kind of addressed to the CEO of all insurers like a letter, right? So let's go through it. We'll follow the same approach. So the main advantage of this circular is it is like a story. So you have to kind of see where it originates, what are the processes, and the most important part is what are the risk management rule that we follow for a derivative. So that is the most important part. In fact, there are question asked on SA2 on I think twice there were question asked on SA2 from the risk management part. So that is very important. So starting uh, now, this was kind of like all the insurers present in India, they were allowed to kind of trade in fixed income derivatives, which are interest rate futures, exchange traded interest rate swaps, exchange traded futures, and forward agreements for a maximum tenure of 1 year, and that was as per Regulation 11 of the Investment Act of the Investment Act. However, it has been like IRDA received representation from the insurer that if they can look into it for a longer duration, like if they can hedge for longer duration. Derivatives are obviously used for hedging, and also IRDA saw a changing investment condition, changing product structure, and also changes in the guidelines issued by RBI. Now in India, the derivatives guidelines are mainly kind of mandated by RBI, and how they are traded, that is kind of mandated by SEBI. So that's why these are two primary regulators for derivatives, especially for the financial derivatives. Now in India, uh, most of the products that we write would be right now would be non-participating products. So there is a risk for the product from decrease of interest rate. So suppose that's because your asset and liabilities are linked, unlike Solvency 2 or IFRS 17, where asset and liability kind of delinked, but here assets and liability are linked. So suppose you are getting a return of 4% in asset, then that 4% will be used to discount your liability. That's because asset and liability are linked, and we'll see this more clearly when you do the ALSM regulation from IRDA, and I think that we'll be doing tomorrow. So there you will see clearly it is written that the yields that you are getting from the bonds invested, that will be kind of used to discount the liabilities, and that's why Indian companies are more concerned about the decline in the interest rate, right? So that's why they use interest rate derivatives. Anyway, coming back to the circular, so because of those change in condition and because of the representation received, what IRDA kind of revised and issued a draft guideline on 18 June 2013, and then based on the feedback received from different industry participants, IRDA kind of revoked the previous guidelines and reissued fresh guidelines, which is as per regulation 8, which is as per regulation 15 of the investment regulation. In this regulations, the interest like Indian insurance company can be allowed to trade in forward rate agreements, interest rate swaps, and exchange traded futures. But those have to be plain vanilla, like derivative interest rate derivatives, and they should not have any options embedded in them, like call option or put option embedded in them. And as I mentioned, the derivatives, financial derivatives are governed by the guidelines issued by RBI, when also it is also kind of influenced by several circulars or guidelines issued by SEBI, right? So hedging, coming to the hedging for forecasted transaction. So when can you actually use the hedge? So you can use hedge for reinvestment proceeds from an investment. So that there you see that since it is a reinvestment proceed, the declining interest rate will impact that, right? Then interest from an investment income, and also the expected premium for life and pension annuity business. right? So all of this would be impacted by decline in interest rate. If the you are so in a non-participating product where there is regular premium, you are not getting, this is not a single premium product, right? So you are not getting all the premium at the same time. So because you are not getting all the premium at the same time, suppose you are receiving the first 100 rupees, that you will probably, right now the interest rate is 8%, so that you are kind of investing at 8%, and next 100 rupees that you receive 1 year later, the interest rate has decreased to say 6%, and that would be invested as 6%, and then there is a mismatch between liability and reserve. You might have reserved or discounted your liability at 8%, then you need to change your assumption, or you also need to think whether it is a long term or a short term. So then there is a mismatch, right? The liability would be more or liability would be less, asset would be more, something like that will happen, right? So that's why a decline is an interest rate is a risk for, especially because Indian insurers like non-participating risk, where this risk are only only belongs to the insurer. Had it been a participating product or maybe unit linked product, then the risk would be shared. So in a non-participating product, the decline of the interest rate risk is very high. That's why fixed interest derivatives are kind of required. Right? Obviously, this will be denominated rupees, so they are called rupee fixed interest derivatives. Now, obviously, when we are kind of considering derivatives, there would be exposure norms, and there would be, as I mentioned, risk management would be very important. So, first of all, in order to determine the risk management, we first of all, we have to kind of go through the exposure. So, what is the exposure there? So, the primary, the counterparty with which you enter with the derivatives, basically the insurer. So, they has to be commercial banks or primary dealers, and as it is kind of mandated by RBI. So the exposure of the insurer would be determined by something which we call credit equivalent amount, and the credit equivalent amounts would be determined by a method we call current exposure method. So the credit equivalent amount of an off-balance sheet market transaction would be determined by current exposure method and future current credit exposure, future credit exposure. Now I have used a term which is called off-balance sheet market transaction. What does that mean? It means that when you are kind of, suppose you have taken a position in future. Now in future, the final delivery of the things or the final transaction will happen at the future date, right? But future are settled mark to market everyday basis. So in this case also, now when it is done mark to market, you might be losing money, you might be gaining money from your margin, but then in that case, that will not be reflected in the balance sheet. Your balance sheet will reflect the end of the period result, right? So that is why this is called off balance sheet transaction, off balance sheet market transaction, because you are considering the mark to market like result on every day, and that's why it will not be reflected in the day, because the only the final day result of the future or call option or put option, that will be reflected, right? So that's why, since mark to market is done every day, it is called off balance sheet market transaction. I hope this is clear. Now, how will you determine the current credit exposure? The current credit exposure is taken as the negative sum of the negative values of the mark to market position, and it is calculated at periodic intervals. The future credit exposure has nothing to do with the mark to market position. So whether it is positive, negative, or zero, the future credit exposure has nothing to do with that, and it's calculated by multiplying with the notional amount, with an multiplying the notional amount with an additional add-on factor. Now, add-on factor will depend on the nature of the derivative and also on the duration of the derivative. So, for a duration of say less than 1 year, it will be 0.5%. For a duration of 1 to 3 years, it will be 1%, and for a duration of more than 5 years, it will be 3%. So, for a say if the notional amount is say 10 crore, and it is of duration 4.5 years, then for the first zero point 0.5, because from 0 to 1 it is 0.5% is applicable, the 0.5% will be applicable. Between 1 to 3 it is 1%, and so since there is 4 years, so it will be 1 plus 1 plus 1, right? So that would be that would be 3.1 plus 1 plus 1 plus 1, that will be 4.5%. Had it been 3.5 years, that would be 1 plus 1 plus 1, that would be 3%. So in this way, it would be applied. So what obviously what the regulation states, or the IIT investment regulation tells, because the derivative is a part of the investment regulation, right? So the credit equivalent amount would be used to determine the exposure as per the IRDA investment regulation. That and how the method is, we have already kind of discussed. Now what will we do is we to determine the industry exposure for exchange traded futures. Now this FRAs and as I mentioned, FRAs and IRS, these are over the counter contracts and they are not traded in the exchange. But exchange traded futures obviously are exchange traded futures. They're traded in the exchange, right? So for these, the industry exposure will be determined by the central counterparty. Central counterparty is the clearing corporation, right? And clearance, I mean, this is a very big concept in for as for example, what do you mean by clearing corporation? Clearing corporation is responsible for clearing all the transactions. Say, as for example, in a stock market, say Nifty, there is an exchange which is called NSE or BSE, right? So when transaction happen through say NSE, BSE are the marketplace. So there is a buyer, there is a seller, and NSE and BSE has to ensure that every buyer is kind of mapped to a seller, and if there is something happening, then the buyer gets paid, the buyer has to pay, and the seller gets paid. So that is a clearing corporation. So exchanges in this case are acting as a clearing corporation. It's a very deep concept. I just gave the surface of it. One can probably Google, because this is a finance related concept or stock market related concept, something which is kind of covered in FRM level 1, or if you are kind of studying ST 6 or SP6, you'll get to learn about that there. Anyways, moving on. So there are obviously exposure limits that are applicable depending on a single issuer, a group of issuer or industry. So for which, so you cannot you get derivatives from a single issuer most of like all the time, or from a single industry cannot have exposure there. Directly or indirectly, you cannot enter into a derivative contract with promoter group. And also the exposure limit has to be kind of informed to the authority or the IRDA in this case, along with the retirement, along with the returns every quarterly. So for and also for the purpose of exposure, it is I mean, it is advised, or it is kind of directed that any applicant company cannot have exposure in fixed income derivatives which is more than the book value in policyholder fund. Policyholder fund will exclude the ULIPs, and as well as in the shareholder fund, right? So, but in some cases, it has been observed that the fund value, the book value of the fund is basically lower than the expected premium, right? And that can happen at very early stage. So if in that case, if for other funds there is exposure limit that is available, then one can increase the exposure limit in such funds. However, one have to maintain that the overall exposure limit is not more than 100%. In this case, any profit or gain that is arising from the derivative activity has to be borne by that fund only. So although you are kind of using the exposure for other fund, the profit or gain cannot be kind of shared with other fund. That is the concept. The investment committee, with an oversight of the board of directors, should be responsible for kind of maintaining this, right? Uh, and then moving on, so there is a documents. Obviously, some documentation is required. The applicants are kind of advised to ensure the documentation is complete, and those are as per the guidelines issued by RBI once again, because RBI is controlling the fixed income derivatives, right? And that is, and they also have to abide by International Swaps and Derivative Association, which is called ISDA. So there is an agreement which is a two-way agreement that is called CSA, called Credit Support Annex Agreement. Now, in this document is related to mitigation of counterparty risk. Like if one counterparty defaults, then what will happen? So because of that, it deals with collateral, which also we call margin. So in future and option, when you are kind of doing future and option, then you'd be required to post some margin or collateral. Like the future might cost, the option might cost much less, but you might, especially if you are selling option, then you need to have extra margin, because then your risk is infinite. So depending on the risk, there is a margin involved, right? So that's what has been called out here. And so the collateral and the posting mechanism was kind of defined in the CSA. However, the financial derivatives will fall under the laws and jurisdiction of the Indian court. And yeah, nothing can be further from the Insurance Act of 1938 or any act, the Insurance Act of 1938, or whatever is written in this guideline. That is this circular, any guideline issued by RBI or SEBI or any other regulatory authority for that matter. Right now, how do you account for, or how do you kind of what would be the accounting treatment of the derivatives? So the accounting treatment of the derivative would be to kind of follow the direct directives that is given by AS30, which is issued by ICI, that is Indian Charter Accountant Institute, the Institute of Charter Accountants of India. So and that the derivative would require the disclosure norms and disclosure norms and risk management, which would be disclosure and measuring norms, which would be kind of given by AS31 and AS32, and it should consider the risk management policy and the objectives and the hedging policy, so for forecasted transaction, the overall hedging policy, the accounting treatment of the derivatives, the exposure, exposure of the outstanding fixed income derivatives, and also one should consider what would happen, the quantification of the risk if the counterparty fails to fulfill the obligation. Now coming to the most important part, which is the risk management part of the derivatives. So risk management policy has to be pre-approved by the board of directors. Right, as I mentioned, it is a policy which is kind of under the oversight of the investment committee, and which is under the investment committee, and investment committee is kind of investment committee would be under the oversight of board of directors. So the policy would state whether the derivative policies as per the risk appetite of the insurer and as per the business strategic objectives and as per its capital strength. So the policy should also call out the approved derivative activities. It should ensure that there are proper amount of staffing and other resources that are required to carry out those approved derivative activities. No other activity can be carried out, but approved derivative activities has to be carried out and in a prudent manner. Now, whenever we are introducing approved derivative activities, there would be a risk management, right? So we also have to ensure that appropriate staffing is available for the risk management function. You have to ensure the applicable, you have to determine the applicable VAR limits, the frequency of reports that would be made to the board of directors, the natural circumstances in which derivatives can be that derivative would come to a closure, the accounting treatment of the derivative, establish management responsibilities, identify areas and the risk to which the company is exposed to, and establish limits for this risk, and ensure that proper risk measurement and risk management methodologies are effective and are in place. So it is the responsibility of the board of the directors to understand and to understand that whether the insurer portfolio and the liabilities are in sync with the fixed income derivative policy, or rupee interest derivative policy, and the board of directors also has to ensure that the policy has been evaluated by the market maker as per the RBI guidelines. So given also the board of the responsibility to the board of directors, or the the management of the company, because when they are kind of dealing with such complex products, they have to understand and they have to ensure that they understand the risk involved, the stress levels, right? And also in the risk management portion, there is a point regarding stress testing of risk positions, right? So you have to kind of because when you are dealing with derivatives, it is a complex product. There will be a lot of risk that you don't understand. There will be operational risk, there will be counterparty risk. So you have to kind of stress test and see that you have necessary capital to kind of back. So that if those risks somehow materialize, you have the capital to kind of take care of that. Now, in this, coming back to the old point, so the board and the management of the insurer has to kind of ensure that they have the sufficient they have the sufficient knowledge of dealing with such complex product. They also understand what is they have the sufficient knowledge to deal with such complex product, and they understand the stress levels, right, that is being done, and they also have to ensure that they meet frequently, at least once a year, to understand that the risk management and policies, risk measurement and risk management policies are in place, and they are also been functional, right? And finally, the final part is related to report and audit. So in report and audit, the before carrying out any fixed interest rate derivative activities, the insurer has to kind of ensure that proper risk management policy is in place, and for that they need to have proper risk management policies, procedures, systems are in place, and for this they need to obtain a certificate from the concurrent auditor, So the concurrent auditor is so required to put a comment in their quarterly report regarding the effective implementation of the risk management policies and procedure, and also regarding the system. Also, the investment risk management system auditor also has to mention a point about the effective implementation of the procedure and the systems for carrying out fixed income derivatives activities in their periodical report. So that is the overall guidelines on the derivatives. If we have to kind of take some 3 points, so that would be derivatives is only for hedging, right? That is the overriding principle. Derivative is the overriding principle. The overriding principle for using any fixed income derivatives is to hedge the transaction. Secondly, in Indian companies, for especially for non-participating product, there is a huge risk of decline in the interest rate, and that's why derivatives will be used. And whenever derivatives is used, there is a risk exposure, and we have to identify some ways to kind of manage or monitor that risk exposure, calculate that risk exposure, which we do by current exposure method by calculating the credit equivalent amount, and the credit equivalent amount is calculated using the current credit exposure and future credit exposure, right? And then there should be a risk management policy in place to ensure that it is as per the risk appetite of the insurer, and it is it is as per the risk appetite, it meets the strategic business objectives, and it's as per in sync with the capital strength of the insurer. So let's go through this guideline once again by going through this documentation, and we can do it faster. So as I mentioned, it's like a story. IRDAI permitted insurer to deal in financial derivatives, permitted and in accordance with the guidelines, right? The said guidelines said that the insurers to enter forward agreements, interest rate swaps, exchange traded futures for a maximum tenure of 1 year only, right? But need was felt to review the above guidelines in view of investment environment, product structure, change in guideline, also representation or receipt. And because of that, accordingly, draft guidelines of fixed income derivatives were issued on 18 June 2013. Comments were sought from all stakeholders. Depending on this guideline, they can trade on forward agreements, interest rate swaps, but and exchange traded futures, but they can only undertake plain vanilla FRS or IRS. They cannot use any option, right? The permission to insurers for rupee interest are generally governed by the guidelines issued by RBI, and also there are some circulars issued by SEBI, right? Hedging of forecasted transaction, herein the decline in the interest rate comes into picture. Reinvestment of maturity proceed, investment of interest income, expected policy premium income from insurance contract which are already in life and pensionable business. So rest is for general insurers who are not kind of interested in that. Overriding principle is that above listed derivatives must be used for hedging purpose, right? This is one of the key point. Moving on, regulatory exposure. The primary counterparties can only be commercial bank and primary exposure, and there would be a credit equivalent amount. Credit equivalent amount is calculated using the current exposure method. Credit equivalent amount is the market related off balance sheet transaction. I've already explained in detail why this is called off balance sheet transaction. Current credit exposure is defined as the sum of the gross positive mark to market. I think I mentioned negative here, so it will be positive gross to market, because when there is positive, then there is a exposure. So we have to be careful here. Positive gross mark to market. The current credit exposure requires periodical calculation, right? Potential future credit exposure is calculated multiplying the notional principal amount, and it depends on the nature and the residual maturity, right? No, so for example, if your IRS is of 10 crore and of maturity 4 years, right? Maturity is of 4 years, so then there would be 1.5% for the first year, and I gave an example of 4.5. Right? So that's why it was time coming out to be 4.5, but here it is 3.5 because 0.5 for the first year and 1%, 1%, 1% for each of the 3 year, right? So had it been 4 year, obviously it would be 4.5%. So that's the example. So this is the credit equivalent amount which is used to calculate the exposure norms. For exchange traded IRFs, as I mentioned, this is a big concept. Clearing corporation would be the exposure limit of the entire industry would be kind of calculated as the clearing corporation. Exposure limit, there will be exposure limit for single issuer group industry, and no contracts would be entered with the promoter group. The counterparty rating shall be considered. So this is one point that I've missed, but yeah, I mean, somehow kind of implied. And the limit shall be counter rating will be considered because there is a default risk, right? That's why rating is important. And the limit shall be reported in a remarks column of the respectively quarterly term. So participant dealing with interest rate under this guideline shall in aggregate not exceed any outstanding notional principal amount equivalent to the 100% of the book value. And the participant under the participant policyholder fund, excluding ULIP and shareholder fund. However, normally added to 100% of the limit of the respective fund in life, and however it is noted that in some funds the book value of the existing investment is lower than expected premium, right? In that case, you can take advantage of the exposure limit that is available in other fund, while with staying within the overall 100% of the limit, right? And the loss and gain that is arising shall be borne by that fund only. If the reinvestment or maturity process from the existing fund receivable shall be held till maturity, the unavoidable need to avoid arises to liquidate the instrument. This is a point that I completely forgot. If there is a, so if you are kind of hedging the reinvestment profit or investment income, and if there is an unavoidable need to kind of liquidate that instrument, the hedge has to be liquidated or unwound at the same time. And IC should, the investment committee shall grant process permission after recording the reason. Moving on, then there is a documentation, there is a trade support annex agreement, and it has to abide by the laws, the Indian laws and jurisdiction. Nothing shall be inconsistent with IRT investment regulation, right? SEBI regulation guidelines. Then accounting of interested derivatives as by accounting 30, right? And they should be present in financial statement. Disclosures are governed by AS 31 and 32. Description of the participant financial risk management objective and policy, particular hedging of forecasted transaction, overall hedging policy, nature, accounting policy of derivatives, nature and terms of outstanding derivatives, and quantification of losses. These are all points that we have covered. Moving on to the internal risk management, there should be pre-approved risk management policy by the board of directors, overall risk appetite, define approved activities, and provide sufficient resource for those approved activities to be conducted in a prudent manner. This portion is very important, to be conducted in a prudent manner. Ensure appropriate structure and for the risk control function. Because there is a derivative, there should be a risk control function. Establish management responsibilities. Identify the risks faced by the insurer and place a limit on them. Establish risk measurement and methodologies are consistent with the nature and scale of the derivative activities. Touched upon this, request stress testing of risk position. Detail the type and frequency, applicable word limits, uh, that is the value at risk limit, circumstances and circumstances of termination, closure of contract, accounting treatment of the proposed derivative in the company, solvency capital impact due to the use of derivative. This is one point that I missed. Obviously, because there is a risk, the capital, the solvency capital, because solvency capital is a risk-based capital, right? Mostly it is risk-based, although in India it is factor-based right now. So when you are holding derivatives, you there will be impact in capital. I kind of alluded to that point, though I have not specifically mentioned about that point. Implementation of the policy responsibility of the investment committee with an oversight of board of directors. No prior approval of the authority is required. Suitability of the interest and suitable portfolio handled by the insurers has to be kind of ensured by the board of directors. The board shall ensure that board shall supervise whether the suitability appropriateness was evaluated by the market maker as per the guidelines issued by RBI. While dealing corporate governance or dealing with such potentially complex product, board and senior management should ensure that understand the risk undertaken, nature of the risk, complexity involved, stress levels. At periodical intervals, the board shall review the contracts undertaken, satisfy themselves adequate risk measurement management possibilities has been put in place, and they are also functional. Reporting and audit. Quarterly report added to be submitted to the authority. If the insurer undertake interest derivatives before trading in interest derivatives, they require a certificate from the concurrent auditor, right? And stating that the suitable system procedures are available and requirements are in place and these guidelines are met, the organizers will also ensure the compliance of the guidelines and have to comment in the quarter report. Similarly, the auditor of investment risk management system process also comment on the system and procedure available in the periodical audits, right? And that's it. This is form annexure A, and this is what is kind of like the insurer has to submit to show their exposure, uh, right? So this is form. We don't require this, but if a company has derivative activities, like we don't need to go through the detail of this, but every insurer need to kind of fill this form and send it to the IRD quarterly, right? Just that they can track this. So that's it. Please like, share, and subscribe if you enjoy the content. If you are learning something, I try to pinpoint to difficult words, as for example, that off balance sheet market transaction, right? And try to explain that in simple language so that you never forget that thing, what is meant by that regulation or that guideline. So please like, share, and subscribe. And if there is any feedback, any comment, please comment about that in the comment section of YouTube. Thanks for watching and see you tomorrow.